My name is Michael, and 3 years ago, I had a mental breakdown in the middle of a bank vault. Not because I was robbing it. I worked there. The breakdown happened because I finally understood what my job really was. For 2 years, I'd been a junior analyst at one of America's largest banks, and I thought I knew how money worked. I thought banks took deposits from savers and loaned them out to borrowers. I thought the Federal Reserve printed all the money. I was wrong about everything. The truth is so much stranger, so much darker, and so completely insane that when my boss finally explained it to me, I literally walked out of the building and didn't come back for 3 days. Today, I'm going to tell you what I learned, and trust me, once you know this, you can never unknow it. I never planned to work in banking. Growing up in suburban Ohio, I wanted to be a teacher, maybe a writer. But then came college debt, $87,000 of it. So when Chase offered me a job as a junior analyst with a starting salary of $62,000, I took it without hesitation. It was 2017, and I was just grateful to have a real job. My first day was overwhelming. The building was a glass tower in downtown Manhattan, the kind of place where everyone wore suits that cost more than my monthly rent. I was assigned to the commercial lending operations department, which sounds boring, and honestly, it was. My job was simple: process loan applications, verify documents, and make sure everything was filed correctly. For the first 6 months, I did exactly that. I'd come in at 8 a.m., sit in my cubicle, and process paperwork. Small business loans mostly. A restaurant owner needs $100,000 to expand. A construction company needs $500,000 for new equipment. I'd check their credit scores, verify their income, and submit everything to my supervisor for approval. I thought I understood the process. Customer wants money. Bank checks if they can pay it back. Bank loans them money from its deposits. Customer pays back the loan with interest. Everyone's happy. Simple, right? But there was something that bothered me. Something I couldn't quite put my finger on. It started with a conversation in the break room. I was having coffee with Tom, a guy who'd been working in the mortgage department for 15 years. He was complaining about how busy they'd been. "We approved 47 mortgages yesterday," he said, rubbing his eyes. 47. That's over $15 million in loans in a single day. I did some quick mental math. Where does all that money come from? I mean, do we have that much in the vault? Tom laughed, actually laughed. The vault? Kid, there's maybe $200,000 in the vault downstairs. It's mostly for show. I stared at him. Wait, what? Then where does the $15 million come from? He shrugged. You'd have to ask someone above my pay grade. I just processed the paperwork. That conversation haunted me for weeks. $15 million in loans, $200,000 in the vault. The math didn't add up. Where was the other $14.8 million? I started paying closer attention to the loans I was processing, a $250,000 loan for a medical practice. Where did that money come from? I pulled up our bank's balance sheet on the internal system. We had $47 million in cash reserves total. But we were approving millions in loans every single day. The numbers made no sense. I became obsessed. Every lunch break, I'd go to the bank's research library. Yes, we had one, though nobody ever used it. And I'd read everything I could find about banking operations, the Federal Reserve System, fractional reserve banking, money supply, M1, M2, M3. The more I read, the more confused I became. Because according to everything I was learning, banks were supposed to keep only a fraction of deposits as reserves and loan out the rest. That's why it's called fractional reserve banking. If someone deposits $1,000, the bank keeps $100 as a reserve and loans out $900 to someone else. Okay, I thought, that makes sense. We're intermediaries. We connect savers with borrowers. But then I read something that stopped me cold. It was a research paper from the Bank of England published in 2014 titled Money Creation in the Modern Economy. I read the opening paragraph 3 times. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. I sat there in that empty library, my hands trembling. Banks create deposits, banks create money. That's not what I'd been taught in economics class. That's not what anyone had told me. I printed the paper, all 14 pages, and stuffed it in my bag. That night, I couldn't sleep. I kept reading and rereading those words. Bank lending creates deposits, creating new money. The next morning, I did something stupid. I walked straight into my supervisor's office, a woman named Patricia Chen, who'd been with the bank for 23 years, and I put the Bank of England paper on her desk. Is this true? I asked. Do we create money when we make loans? Patricia looked at the paper, then at me, then back at the paper. She sighed deeply. Michael, sit down. I'd rather stand. Sit. Down. I sat. Patricia folded her hands on her desk. Who gave you this paper? Nobody. I found it myself, in the research library. Of course you did. She massaged her temples. Okay, yes, it's true. Banks create money when they make loans, but it's more complicated than... How is it complicated? I interrupted. Either we create money or we don't. We create deposits, she corrected. There's a difference. The paper says deposits are money. Michael, calm down. But I couldn't calm down. 2 years. I'd spent 2 years processing loans thinking I was just moving existing money around, and the whole time I'd been participating in what? Magic, fraud. Is it legal? I asked. Patricia's expression softened slightly. Yes, it's completely legal. It's how the banking system has worked for over a century. It's how all banks work. Chase, Bank of America, Wells Fargo, everyone. But nobody talks about it. Why doesn't anyone talk about it? She leaned back in her chair. Because, Michael, the average person doesn't need to know how the sausage is made. They need to know they can deposit their paycheck, take out a loan, and trust that the system works. And it does work, mostly. Mostly? Patricia stood up and walked to her window, looking out over the Manhattan skyline. 2008, she said quietly. That's what happens when the system doesn't work. When banks create too much money, make too many loans, and everything collapses. I felt sick, literally nauseated. So what am I supposed to do with this information? She turned to face me. You have 2 choices. 1, forget about it, do your job, and collect your paycheck. Or 2, learn more, understand the system, and decide for yourself if you can live with it. I chose option 2. Patricia, to her credit, didn't fire me for my outburst. Instead, she did something unexpected. She became my teacher. Over the next 3 months, she explained exactly how modern banking works. And let me tell you, it's even more insane than I initially thought. Here's what I learned. When a bank approves a loan, let's say $100,000 for a small business, the bank doesn't go to a vault, pull out $100,000 in cash, and hand it to the borrower. That's not how it works. Instead, the bank literally types numbers into a computer. They open the borrower's account and add $100,000 to the balance. That's it. That's the whole process. The bank just created $100,000 out of thin air. But wait, you might be thinking, don't banks need to have money to lend? And the answer is not really. Not in the way you think. Banks are required to hold reserves at the Federal Reserve, basically a certain percentage of their deposits. For most of U.S. history, that percentage was around 10%. So if a bank had $1 million in deposits, they needed to keep $100,000 in reserves at the Fed. But here's the crazy part. That 10% requirement wasn't a limit on how much they could lend. It was just a buffer. A bank with $1 million in deposits and $100,000 in reserves could theoretically lend out $9 million, creating $9 million in new deposits in the process, as long as those new deposits eventually settled across the banking system. And it gets crazier. In March 2020, the Federal Reserve dropped the reserve requirement to zero. That's right, zero. Banks no longer need to hold any reserves at the Federal Reserve. So what stops banks from creating infinite money? I asked Patricia during one of our sessions. 3 things, she said, holding up 3 fingers. 1, capital requirements. Banks need to hold a certain amount of actual equity, money that belongs to the bank itself, to absorb potential losses. 2, demand. Banks can only lend as much as people want to borrow. And 3, risk. If a bank makes too many bad loans, it goes bankrupt. Simple as that. But how is this not counterfeiting? Patricia smiled. Because the government says it isn't. Money is whatever the government says it is. And the government has decided that bank deposits, numbers in computer systems, are money. So when banks create deposits, they're creating money, legally. My mental breakdown happened 3 weeks after that conversation with Patricia. I was giving a tour to some high school students, part of a financial literacy program the bank sponsored, and one of them asked to see the vault. We went downstairs to the vault room, this big reinforced door straight out of a heist movie. The security guard opened it, and we walked inside. There were stacks of cash in sealed bags, some gold coins in display cases, and rows of safety deposit boxes. One of the students, a girl wearing a Yankees cap, looked around and said, "This is where all the bank's money is, right?" And I just lost it. I started laughing, hysterically, couldn't stop. The security guard looked concerned. The teacher looked confused. The students looked terrified, because the answer was no. This wasn't where the bank's money was. There was maybe $200,000 in that vault. Meanwhile, at that very moment, our bank held over $900 billion in deposits, with a B billion. $900 billion in deposits, $200,000 in the vault. The ratio was so absurd, so completely disconnected from reality that I couldn't handle it. I excused myself and walked out of the building. Didn't tell anyone where I was going, just walked, for hours, through Manhattan, across the Brooklyn Bridge, all the way to Prospect Park. My phone kept buzzing, Patricia calling, HR calling, but I ignored it. I sat on a bench and tried to process everything. Every deposit in that bank, every checking account, every savings account was just a number in a computer. Numbers that the bank had created mostly out of nothing by making loans. And everyone just believed in those numbers, acted like they were real. And then I realized something even more disturbing. Those numbers are real. As long as everyone believes in them, as long as the system keeps functioning, those numbers have value. They can be used to buy houses, cars, food, anything. The belief makes them real. Money, I realized, is the biggest collective delusion in human history. and I'd been helping maintain that delusion for 2 years. I went back to work 3 days later. Patricia didn't ask where I'd been. She just said, "You okay?" "I don't know," I answered honestly. "Come on," she said. "There's someone you should meet." She took me to the executive floor, somewhere I'd never been, and introduced me to David Keller, the bank's chief risk officer. He was in his 60s, gray hair, expensive suit, kind eyes. "Patricia tells me you've been asking good questions," he said, gesturing for me to sit. "I've been asking disturbing questions," I corrected. He laughed. "Same thing." "Listen, Michael, I'm going to tell you something that might help. The banking system, this money creation system, it's not a bug. It's a feature. It's designed to work this way. But why? Why not just use real money, physical money?" David leaned forward. "Because there isn't enough, and there never was. If we only used physical money, coins and bills, the economy would collapse. There's only about $2 trillion in physical U.S. currency in circulation. But there's over $20 trillion in bank deposits. If everyone tried to withdraw their money at once, the system would implode. It's impossible. The money doesn't exist. So it's a scam." "No," he said firmly. "It's a system. A system that allows economic growth. Think about it. When a bank loans money to a small business, that business can hire employees, buy equipment, expand. Those employees spend their paychecks. The economy grows. If we could only lend money that physically existed, there would never be enough money to facilitate all the economic activity we need." But what about inflation? If banks are constantly creating money— "That's what interest rates are for," David interrupted. "The Federal Reserve controls inflation by adjusting interest rates. When rates are high, borrowing is expensive, so banks create less money. When rates are low, borrowing is cheap, so banks create more money. It's a balancing act." "A balancing act that failed in 2008, I pointed out. His expression darkened. "Yes, it failed in 2008, and in 1929, and in 2000, and it'll probably fail again someday. The system isn't perfect, but it's the system we have." Over the next year, I learned more about the dark side of money creation, the side that David Keller had glossed over. Because here's what he didn't tell me. When banks create money through loans, they create debt. For every dollar that exists in the system, someone owes that dollar plus interest to a bank, which means, mathematically, there's more debt in the system than there is money to pay it off. Think about it. If banks create $100 and charge 5% interest, borrowers need to pay back $105. But only $100 exists. Where does the extra $5 come from? From more loans, from more money creation. The system requires constant growth, constant borrowing, or it collapses. It's a treadmill, and we're all running on it. I also learned about bank failures, about how when people lose confidence in a bank, they rush to withdraw their money, a bank run, and the bank collapses because it doesn't actually have the money. It only has numbers in a computer. That's what happened to Silicon Valley Bank in 2023. Customers tried to withdraw $42 billion in a single day. The bank didn't have $42 billion. It had already lent most of it out, so it failed, collapsed in 48 hours. And here's the terrifying part. Every bank operates the same way. Your bank right now doesn't have your money. If everyone with an account at your bank tried to withdraw their funds tomorrow, your bank would fail, guaranteed. The only thing preventing constant bank runs is FDIC insurance. The government's promise that even if your bank fails, you'll get your money back, up to $250,000. But that promise only works if not too many banks fail at once. If there's a systemic collapse like in 2008, all bets are off. I couldn't fully understand the banking system without understanding the Federal Reserve, so I spent months researching it. The Federal Reserve, despite its official-sounding name, isn't actually part of the federal government. It's a quasi-private institution, a hybrid. It was created in 1913 by Congress, but it's owned by member banks, the same banks that benefit from the system. The Fed's job is to manage the money supply and control inflation. They do this primarily through two mechanisms. One, setting interest rates. When the Fed raises rates, borrowing becomes more expensive, so banks create less money. When the Fed lowers rates, borrowing becomes cheaper, so banks create more money. Two, buying and selling government bonds. When the Fed buys bonds from banks, it credits the bank's reserve accounts, literally creates money, giving banks more capacity to lend. When the Fed sells bonds, it removes money from the system. But here's the insane part. The Federal Reserve creates this money out of nothing, just like commercial banks. When the Fed buys $1 billion in bonds, it doesn't take $1 billion from anywhere. It just types the numbers into a computer. It creates $1 billion out of thin air. Between 2008 and 2014, the Federal Reserve created $3.5 trillion, this way through a program called quantitative easing. They just made it and used it to buy bonds and prop up the financial system after the 2008 crisis. $3.5 trillion created from nothing, with keystrokes. By my third year at the bank, I'd become numb to the insanity of it all. I processed loans, I filed paperwork, I collected my paycheck. But the moral question never left me. Is this system ethical? On one hand, money creation enables economic growth. It allows people to buy homes, start businesses, go to college. Without bank-created money, the economy would be a fraction of its current size. There wouldn't be enough money to facilitate all the economic activity we depend on. On the other hand, the system concentrates power in the hands of banks. They get to decide who gets loans and who doesn't. They create money when they lend it out, charge interest on money they created from nothing, and if the loan defaults, they seize real assets, homes, businesses, property, as collateral. They're playing with house money, literally. And when banks screw up, when they create too much money, make too many risky loans, and nearly destroy the global economy, taxpayers bail them out. That's what happened in 2008. Banks privatize their profits and socialize their losses. I also learned that the system perpetuates inequality. Rich people and corporations have better access to credit. They can borrow at lower interest rates, invest in assets, and get richer. Poor people pay higher interest rates, accumulate debt, and stay poor. The system isn't designed to be fair. It's designed to be profitable. After understanding how the current system works, I became obsessed with alternatives. Is there a better way? I looked into cryptocurrency, Bitcoin, Ethereum, all of it. Decentralized money, they said. No banks, no government, just code and mathematics. But the more I learned, the more I realized crypto has its own problems. It's volatile, energy intensive, and most people don't actually want to be their own bank. They want convenience, security, and someone to call when something goes wrong. I looked into full reserve banking, a system where banks could only lend out money they actually have, not money they create. But economists argue this would cripple economic growth. There wouldn't be enough money to fund investments, mortgages, business expansions. I looked into modern monetary theory, the idea that governments, not banks, should create money directly. But that has its own risks, particularly hyperinflation if politicians abuse the power. Every alternative has trade-offs. Every system has flaws. I'm still working at the bank, still processing loans, still participating in the system. Why? Because I don't have a better option. And because, as messed up as it is, the system works, mostly. It's flawed, it's unfair, it's built on collective delusion, but it functions. It allows society to operate at a scale that wouldn't be possible otherwise. Do I think it needs reform? Absolutely. Banks should be more heavily regulated. Wealth inequality should be addressed. The financial sector has too much power. But burning down the system without a viable alternative would cause more harm than good. Millions of people depend on this system for their jobs, their savings, their mortgages. You can't just flip a switch and replace it. What I can do is educate people, tell them the truth. Because the biggest problem with the banking system isn't that it creates money, it's that nobody knows it creates money. People think their deposits are safe, that banks are just storing their money, that the system is solid. It's not solid, it's fragile. It's based on confidence, and confidence can evaporate overnight. So what should you do with this information? First, understand that your bank deposits aren't really yours in the way you think. They're IOUs from the bank. The bank owes you that money, but it doesn't have it sitting in a vault somewhere. It's been lent out, invested, turned into other assets. Second, diversify. Don't keep all your money in one bank. Don't keep all your wealth in one form. Bank deposits, physical cash, investments, real estate, spread your risk. Third, be careful with debt. Remember, when you take out a loan, the bank is creating that money from nothing and charging you real interest on it. Make sure you're getting value from that loan. A mortgage for a home? Probably good. A credit card balance for consumer goods? Probably bad. Fourth, pay attention to the warning signs. Rising interest rates, bank failures, stock market crashes. These are signs that the money creation machine is breaking down. When you see these signs, be prepared. Have an emergency fund, have a plan. And fifth, demand transparency. The banking system operates in the shadows because it benefits from public ignorance. The more people understand how it works, the more pressure there is for reform. It's been 3 years since my breakdown in that bank vault. 3 years since I learned the truth about money. And you know what? I'm okay now. Not happy with the system, but okay. I've learned to live with the cognitive dissonance, to accept that money is both real and fake, solid and illusory, essential and absurd. It's Schrodinger's currency, simultaneously everything and nothing until you try to use it. The bank where I work is still creating money every day. Billions of dollars conjured from thin air with keystrokes. And tomorrow I'll go back to my desk, process my loans, and help maintain the grand illusion. Because that's what it is, an illusion. But it's an illusion we all need to survive in the modern world. Patricia retired last year. Before she left, she stopped by my desk one last time. "You doing okay, Michael?" she asked. "Yeah," I said. "I think so." She smiled. You know what the crazy thing is? Even after learning all this, most people don't change anything. They keep depositing their paychecks, taking out loans, trusting the system. Because what else can they do? She was right, of course. What else can we do? The system is bigger than any individual. It's woven into the fabric of society. You can't opt out. You can only understand it, work within it, and hope it doesn't collapse on your watch. But now you know the truth. You know how banks really create money. You know that your deposits are just numbers in a computer. You know that the whole system is built on confidence and collective belief. So what will you do with this knowledge? Will you ignore it? Go about your life and pretend everything is fine? Or will you look at your bank account differently? Question the system. Prepare for the possibility that someday the illusion might shatter. The choice is yours. But you can't unknow what you now know. Welcome to reality. It's more insane than you ever imagined.